everyone. Thanks for joining this episode of Joint Custody. My name is Benjamin Duve. I'm the Global Head of Partnerships at GK by Galaxy, and I'm excited to have you, but also excited to have Prashant on the podcast. Prashant, maybe you do a quick introduction of yourself.
Thank you, Ben, and very excited to be here and appreciate the invitation. Hi, all. My name is Prashant K. I'm a managing director at EY in our strategy group, EY-Parthenon, and I lead our digital asset strategy and M&A offering at EY. So I've been working for the past 6, 7 years with banks, asset managers, asset servicers, wealth managers, networks, and all things digital asset strategy, covering crypto, blockchain, tokenization, stablecoins, as well as working with some of the digital natives on topics of growth. And I've also supported a number of private equity firms that, with due diligence, as we've seen a lot of deal activity in the space. So very excited to share my thoughts today.
Well, it sounds super interesting, and you look at the broad space of the industry, not only the TradFi five bit only, but you look beyond that as well. But how did you get into digital assets? That's always a very interesting story mostly people have.
It's a very interesting one. So obviously, when Bitcoin came out, and then there was all the news around it, I had read the white paper, was following what was happening in social media. But how I personally myself got into it, I was actually doing a project with a client back in call it 2016, and one of my main clients was the head of product for a wealth manager. And I remember having conversations with him, and he was responsible for their funds and their ETF business. And randomly, he brought up Ethereum, and we started talking about that. And at that point, price was around $1.60. And I kind of brushed it off. And a few weeks later, we met again. He said, "Hey, have you been following Ethereum? It's now around 16, $17." And I said, "Oh, that's interesting. I remember seeing the hype with Bitcoin," and I kind of brushed it off. And a few weeks later, we met again, and he said, "Hey, the price is now in the mid 100s." And so we stopped the meeting, and I opened up an account on the spot, and he showed me how to buy cryptocurrency. And so that's how I personally myself got into it. And then I really just got excited about the concept of electronic peer-to-peer money movement.
It's like I have these a lot, right? It's like that random, you have a genuine interest, right?
Yeah,
Like a hobby interest, and then most people then have like a random encounter in their work and they then get into that. And I think the difference is if you grab that opportunity or if you let it pass. And you obviously grabbed it, but you didn't buy enough crypto. You're still here with
I'm still
me,
here.
and we both have to work, right? So I think that's a common thread for both of us for sure, right? Um,
Exactly.
so let me ask you a quick question in the beginning, right? Because you say
Yeah.
EY Parthenon. I mean, can you explain what EY is doing, what EY Parthenon is doing, and maybe carve a little bit out what the difference between the two is for everybody
Yeah.
not too deep into the differences?
Yeah, absolutely. So EY has four service lines: tax, assurance, consulting, and Parthenon. So across all four service lines, we've got a digital asset team and solution covering different capabilities. So we have folks advising on tax matters related to digital assets. We have folks doing assurance matters and audits of digital asset products and digital asset firms. We have our consulting firm, our consulting group, which is providing advisory around operations, risk, compliance, and operating model matters. And what we're doing here in Parthenon is advising clients on their digital asset strategy, what they should do with the new technology, and on M&A matters.
That's interesting. You have the forward view, basically, right? You have the very forward-looking view, while the others seem to be a lot more operational than and more in the day-to-day business. Is that correct?
We are running a lot of our market research. Right now we're going to jump into talking about the survey and what's happening
Yes.
there. But we are spending a lot of time with clients understanding what they're looking to do, how it might impact their business, what's potentially even the risk of an action, right? That's often a common question. If we don't do something, what might happen to our custody business, to our wealth business, to our payments business? So we do a lot of that scenario thinking and forward thinking.
Super interesting. So great to have you here. You might be able to give some very good insights, right? And one of them, I just read the report the other day, is that very heavily cited report you did together with Coinbase, you co-authored as well, right? And
Yep.
walk us through some of the key findings. Maybe the AI summaries everybody sees on LinkedIn doesn't pick up on, or some of the depths and insight, the standard AI
Yeah.
read up you get shared. doesn't pick up, right? Because I think there's a lot of nuances in it, but you might be very well positioned to give us a few of those nuggets.
Definitely. So I would say if you look at some of the headlines, there's obviously going to be some of the stats around institutions planning to increase allocations. But really, what we saw out of the paper was, and out of the report and survey, was that institutions are getting more disciplined. So, yes, 73% plan to increase allocations. But what was really interesting is 50% noted that the recent volatility experience, call it Q4 to early Q1 this year, has really increased their emphasis on risk management, liquidity management, and position sizing. So the core message that we really took away was volatility hasn't driven retreat; it's more so driven discipline and discipline focus as they go forward. We also a couple of the key themes that really came out of it was there's this balance of some institutional investors really looking at regulated access to digital assets. Right, there was a big trend towards wanting to get exposure via ETFs, ETPs, vehicles that they're comfortable with. And as they're looking to build out digital asset capabilities as an institution, they're looking to partnerships. They're not looking to build internally. And as they look at their partners, the standards have really tightened and changed. Interestingly, last year, when we looked at what was your top consideration when exploring a custodian, fees and cost was number one. This year, I think it was at the bottom. This year, the top were regulatory compliance, protocols around security key signing. And so, what that tells us is that the education and awareness around how to look at these vendors has really increased, and cost is no longer one of the deciding factors or one of the key deciding factors.
Well, I think I ran a custody business many years ago for Commerce Bank, right? So, and the discussion already like 6, 7 years ago when we applied for crypto custody law, we were planning to apply for crypto custody license. And back then already, my feeling was twofold, right? The risk of losing an asset is so high and so detrimental to your the business, but also to your capital. A few bucks savings isn't really worth it. And the other issue we had back then is I looked at the sub-custody model, and for me, it was always a tricky one because in a sub-custody model, you assume everything you just described is done very well, but by an external party you don't have any control over. So it's always the bet against can you do it better yourself or you trust somebody else to do it better? And I think part of it might be an easier on-ramp with an external custodian. Later, it might be a mix, depending on where you need your assets to be. But ultimately, my feeling always was if I'm large enough and I have the feeling it's a sizable amount of assets, I would like to be sure they are there and can't get lost because there's no ultimate person to have a recourse at in crypto, right? If they're gone, they're gone. So I would rather do it myself because I did trust my operations who did the regular custody work for many years. But I mean, you have a view on that, or
Yeah, so that's actually an often a question we get asked. Do we buy, do we build, do we partner? Um, a lot of our clients, as they're thinking about digital asset custody, and sorry, apologies for that. So a lot of our clients, as they're looking at digital asset custody and what is their role, they're often thinking, is custody core to my business? Is my client demand large enough to warrant? Obviously, what you're getting at is the expenses and the oversight, the
yeah,
operational expertise, the talent needed to properly do it myself, which is therefore where we're looking at firms using custody tech providers to spin up their own solutions and be their own custodian. Or if they're not large enough, if they don't feel they have the right talent, the right expertise, they don't have the budget, or maybe perhaps it's more of an accommodation versus an actual area that they're looking to build into. That's where they're making the trade-off of I'm going to partner with a qualified custodian to custody. And frankly, some of them decision is we've got clients that want these assets. Let's start with a partnership with a qualified custodian. Let's see how it goes. Let's get our organization smart, trained up, and if the business case warrants it, we'll transition to an in-house solution, which we will build through a custody tech provider.
agreed. And I think the bit is you need the business case to justify the investment. So building up with a partner to then go into build what I agree. And it's a decision we all take in traditional or did. I'm now in a different position, but we
Yeah.
do take in today as well. Do you go directly to a CSD? Do you use a sub-custodian model, right? The only difference is the CSD can't really use your assets. So there's like a different
Yeah.
nuance to it, but you did already in the past, also in traditional assets, decide on where do you want to park them, how to use them. Asset safety, I remember we had on-site audits by operations teams at our sub-custodians around asset safety, and also legal reviews and so on. So I think it's a very, very similar process. The only difference is the trust needs to be even bigger because your sub-custodian can actually lose something for you. So I think
Yeah.
that's an interesting one. But from when I understand what you discuss, it's a very all of those are not very new things, right? When you talk about risk around being more mature about risk profiles, who to deal with, who your counterparty is, it's basically just an evolution, isn't it? Because that's what I mean. I said in an investment bank as the custody business at the last row, right? That's all the whole floor did the whole day. It's like make sure there's not too much risk, how to execute, how to properly select counterparties. I was on a
Yep.
broker committee, so all of those things were.
Counterparty risk, third-party risk,
Yes,
exactly. Yep.
exactly. Those
Yeah.
are very common themes, right? You have the different buildings, different people, ensuring that all of this runs in a proper risk adjusted mode. What you described to me is just what regular banking does, isn't it?
Exactly. And so I think firms are taking that same approach as they make their decisions. They're looking at the cost, the potential revenue, the risk. Do they have the expertise? What a lot of firms are finding, though, is as they now look at potential digital native partners, they're realizing a lot of their vendor due diligence, cyber due diligence, third-party risk management frameworks and approaches don't necessarily account for the nuances with digital assets, with custody, with
Yes.
key management, policy management. So that's often where we're seeing a lot of our clients and helping a lot of our clients with is uplifting those approaches. What are different things you need to take into consideration? How does it impact your scoring, your onboarding, the financial health, the reputation of the counterparty? And so, to your point, Ben, it's a similar approach that banks take when looking at partnering with third parties, especially fintechs. But there's nuances that are specific to digital assets, which a lot of our clients are working through.
Yeah, agreed. As I said, you can lose it. Also,
Yeah,
the liquidity pools might not, the liquidity pools you want to trade with might not always satisfy all of the usual ways you
liquidity
do things,
tests.
right?
Yeah,
So you have
yeah,
to
yeah.
take a certain risk, or might deviate from certain things in that new world because you want to access certain liquidity pools, for example. I think that's one of the discussions I had a lot. But what else is interesting? Like, is it like a something that completely surprised you when you saw that, or was it more a confirmation of a? It sounds like a professionalization of the industry.
Definitely sounds like a professionalization of the industry. And another interesting stat that we found was, we always ask the question, as an institutional investor, as an institution, do you prefer to engage with TradFi firms for services, whether it's custody, whether it's trading, whether it's risk management, et cetera, or crypto natives? And we've seen those responses change over the years. Years ago, it was a big majority preferred the TradFi firms. That's who they were comfortable with. The last thing people want to do, we talked about TPRM and risk and onboarding, is bringing new vendors through a process. Sometimes that can take quite an amount of time. What we saw this year was the number is actually shifting a little bit. So 53% did note they prefer TradFi firms for capabilities, whether it's custody or trading. So it still is a bit more than 50%. However, 22% noted they have no preference between the two, so they were indifferent, and around 26% noted they actually prefer engaging with a crypto native. And so when unpacking that, digging into that, those that prefer the TradFi firms, there's we trust the brand, we trust the reputation, they're already an onboarded approved vendor. We want to be able to see all our positions in one place. We don't want to deal with multiple workflows. So those are some of the what we felt is, those responses make sense.
Use the credit limits, right? I think that's the big thing.
Exactly.
And use my established collateral and credit limits at the place where I have 99% of my business, right?
Exactly, exactly. And probably they have more negotiating power as well when it comes
Yes.
to pricing and fees. But the 26% that noted crypto native, they prefer to partner with crypto natives. Actually, what we're seeing now is responses like they've been in the industry and business much longer. They know what they're doing. They can innovate faster. They have capabilities which will, outpace what the TradFi firms can offer. And so we're actually seeing now that balance of there's that, we trust the people we've been working with for the past many decades, but also for this new asset class, we're also starting to trust these firms which have been in the space for 10 plus years. This isn't something new they're starting in the past year or so. They've got the capabilities. They're innovating fast. They're innovating one step ahead of where I am. And so there's that growing number percentage of firms which are actually more inclined to want to engage directly with crypto native firms.
It's an interesting one because I looked at it right in the beginning, thought, oh, TradFi is catching up and now getting the majority stake. But
Yep.
I sat down, I thought about it, and it's well, if you assume 100% will be digital down the road, right?
Yeah.
Any asset class will be digital. And right now, 100% of that traditional assets are serviced more or less, maybe 99 point something percent now because of some tokenized stocks. But let's say 99% are currently captured by TradFi. It
Yep.
basically means that the wallet share of TradFi might, or what today is TradFi, might reduce to 50% or 49% or 47% are up for grabs. I think if I looked at it, that's also a way to look at it, right? That there's really an opening and a reshuffling opportunity in the industry, but also for new players to really come in and grab some of that substantial market that is out there around securities, for example.
I'll look at it a few ways. I think one way is um, there's definitely an opportunity up for grab when it comes to specific digital assets, right? So when you think about the overall market of digital assets compared to traditional assets, quite small still, but to your point, is growing, and there's certainly a hypothesis we have and many have that the amount of digital assets out of the total amount of assets will start to grow. We've seen stats out there by 2030, 2030 is roughly 5.5 to 10% of assets will be on chain, whether it's money, whether it's securities, crypto, et cetera, et cetera. So that pie is growing. Right now, it's much less than 1%. So there's that opportunity both for the digital natives to think, look, there's opportunity to be made to engage directly with clients, to engage directly with institutions. And on the flip side, there's the opportunity for the TradFi firms as they see um, their clients potentially being more open to engaging with fintechs and new arrivers. It's more of them to think about from a defensive play or from an offensive play. What can I do to keep that asset flow, keep that business, or keep that business with me? So I would look at it in a couple of different ways. Of there's an opportunity for some firms. There's also an opportunity to be a bit defensive, for others as well.
Maybe we dive into that theme because it's quite interesting, right? And you talk to both, right? So
Yep.
I'm a digital native firm, right? Showing up to you,
Yeah.
you have a lot of those listeners. What do you advise them to do to grab that opportunity? Because on the other hand, the investor or the firms you
Yeah.
pitch for many times are traditional firms because they
Yeah.
still have their client connected. What do you tell them? How to prepare for, how to pitch to, how to engage?
Yeah.
Because there might be a few interesting insights there for everyone listening
Yeah.
and maybe get some free EY advice, right?
So years ago, I remember meeting with a bunch of our TradFi clients, and they would say, we've met with firm XYZ, ABC across the digital native, crypto native space, and the resounding point was they don't understand our business, they don't understand regulated financial services, they don't understand regulation. Yeah, they've got a cool product, but there's a big delta in understanding. So one of the big areas that we've seen a lot of our digital native clients do is really focus on making sure that folks that are leading business development, product, understand the clients that they're looking to serve, the traditional financial space. Yes, there's that bit of duality of, I think there's a bit of duality in the market where probably 10 years ago, the digital native space wanted to completely, overtake the traditional financial space and
Yes.
said, we don't need them.
I
We don't
was in
need
the
any
traditional
intermediary.
side. I had those guys always in the meeting. They said like in 10 years you're gone. I remember those
Like
days.
in 10 years, they're not going to exist.
Yeah.
We don't need
Yes.
intermediaries, et cetera, et cetera. I think that caused a lot of eye rolling. And then I think that also made a lot of the digital natives realize, look, if we're going to really grow this industry, if we're going to support adoption, we need to come together. We need that integration between the two worlds. And so where we're seeing digital natives, work with TradFi firms, it's do they really understand the business? Do they come with a risk and regulatory compliance lens forward? Is that something that's a focus? And we've really seen that over the past few years where a lot of the conversations are around, you know, look at the licenses we have, look at our compliance programs, look at our AML fin crime policies, et cetera, et cetera. And that's really when we're on the TradFi side and we're supporting our clients with RFPs with digital natives, those are big areas of focus. But less focus, frankly, on, can you custody or support trading of the 100th market cap token? more so focused on, what are your policies? What are your, how do you support with things like detecting fraud? How do you support tax reporting? How do you integrate with our existing infrastructure? That's really what they're looking for.
It's an interest. It might lead to or be connected to that 22% as they are getting more professional or
Yeah,
professionalizing. I mean, that's basically what you're describing there as well. That's
yeah,
more of that is happening, and that's why more people answering to your survey feel comfortable also with the digital natives because if they are professional, as you described, and they have the product innovation, you when you partner with them, you actually are at the forefront, potentially outcompeting your
your
traditional
peers. Yeah,
competitors, right?
yeah,
And your
yep,
peers.
exactly. Yep.
And now let's see the other side, right? We have a lot of listeners who come from the more traditional side. Let's
Yes.
assume I'm not as well versed. I'm not as much into it. What are the first steps I should take? What should I look at, right? I probably shouldn't immediately build out my custody business, trading everything.
Yeah.
So, how do you step in? How is that organizational learning? What do you tell them to focus on to maybe in a year be in a position to really decide which
Mhm.
direction they want to go?
So I would say we kind of view the TradFi firms across three levels of maturity. There are some firms which we would refer to as they have a high level of maturity. They've been at this for 10 plus years, investing, building, partnering, acquiring, launching capabilities. They've got established teams. They've got funding for use cases and for products. And I think those, there's a few select large banks, asset managers, wealth managers, et cetera. They see the business case. They also see the future vision of digital assets and blockchain, and so they're full steam ahead. There's those, but where I think is it's quite interesting now is with the mediums and low maturity. We're starting to see more firms that are growing up to medium maturity where they're no longer asking why should I do this or why should I care about digital assets. They're more so asking what should I do and how should I do it. And so that's where we're seeing more firms. They're starting to establish a digital asset team. They're getting funding to at least define their strategy. They're starting to think about education, right? There's a number of firms they're working with where they have us come in and do a 2 hour training for everyone across risk and compliance and internal audit on these different topics. And so they're investing in upskilling and training their talent, the resources on these topics. And then there's a number of firms on the tail, which we refer to as the low maturity, which frankly the low maturity are getting a bit more mature, where they're also less asking why should I do this? They're more so understanding that something will need to be done. It's more so around internally, how do they prioritize? They're probably smaller banks, smaller wealth managers, asset managers, observing the big firms and seeing what they're doing. But I would say for firms that are just starting out, it's education. There's a lot of resources out there. Getting your folks educated before just seeing what's on the news, getting your risk departments, your legal, your compliance, all your enterprise functions educated as well is very important because where we've often seen some firms flat fall is when you have someone in product or strategy trying to do something and they're not bringing their enterprise functions along with them.
But that sounds like a very reasonable advice, right? So,
Yeah,
how would you, if in those buckets, right? And I think you're
yeah.
you're mostly US focused, right? How would
We
you,
we've got a global footprint. We have
just from your
yeah,
global perspective, how would you bucket it? And is there a difference between maybe Americas, a
yeah.
EMEA, and then APAC perspective?
Yeah, there's different, I would say there's different use cases, right? So in LATAM, we're seeing a lot of payments and stablecoin use case,
Yes.
right? With currency fluctuation, pay and payouts with, contract workers. So the stablecoin and money movement conversation is a conversation we're seeing pick up over there. In APAC, right, that's been always been a pretty active trader community, even in traditional securities. And so, I think there's been a lot of trading activity out there, a lot of, investor interest in digital assets. There's also in some regulatory regimes, which have been quite supportive of innovation and sandboxes and supporting these products. And so we've seen for the past many years a lot of innovation coming out of there. Middle East as well is an area that for the past year or two we've seen a lot of frankly digital natives move their headquarters there, looking to engage, looking to expand out. Obviously, right now there's been some pause with some of the activity happening there, but it's been an area where there's been a lot of investor interest, crypto native firms moving out there. I would say a year or two ago, the US was still very exploratory, but with it's a lot of the regulatory guidance that has come out with Genius Act and executive orders and guidance from the regulators. We're seeing all, majority of banks, asset managers, wealth managers, TradFi firms be very open to exploring the technology, opening, offering products, bringing capabilities to market. So we are seeing some differences in the focus, and frankly, a big resounding theme behind that is the regulatory, guidance and clarity that's happening across these different regions. Europe as well, with MyCard a year and a half ago, that really propelled a lot of activity as well.
But I have to say, I work now in a US based firm, right? And also one of my prior employees, also
Yeah,
US based firm. I think the
yep,
one difference is if there's a path to execution and money to be made, I have to say the US is just much quicker, right? It takes a while to ramp up, but
yeah,
once the capital allocation and the decision has been made, the execution, it's just a different culture, I think, around it. The execution is just more stringent and faster. And you can have iterations, right? You can execute, then fail, then
yeah,
continue to execute. Well, probably I can say from a European, we first plan this out for the next 10 years. And then
yeah,
it takes quite a bit of effort. It's very well thought out.
yeah.
But then it takes quite a bit until you start executing, and then many times others are there. And I think with regulatory clarity in the US and everybody understanding the speed of execution in the US, I think people got more enthusiastic or saw the need, right, to compete. Because I mean, a lot of
Yeah.
indirectly, if you look at APEC and other regions, they sell into the US, right? So the moment the US is getting up to speed, right, basically it erodes your client base as well if you don't only focus on your local clients.
An interesting point you're hitting at. So, as leading our strategy effort, one of the pieces of advice I give for digital assets, for Gen AI, for all emerging tech is, don't waste time trying to develop the picture perfect strategy. You can see firms spending 3, 4, 5, 6 months trying to do that, and the market's already innovated, on a monthly basis.
Yep.
Come up with some initial use cases, come up with some initial no regret decisions, and get moving, get building, get your hands dirty. Try out the technology, see how it works internally in your organization, establish partnerships, move forward on a couple no regret actions, whether it's spinning up wallets, supporting on and off ramps, looking at compliance, right? There's some no regret actions that we're seeing a lot of firms, they just get moving. It'll help push things forward versus waiting for that picture perfect PowerPoint presentation, which is put together after a few months.
That's always, I did a few strategy roles, right? And my very clear picture was you have to have the North Star and the vision where an
Yeah,
organization should go, right? That's important. But then you
yeah,
build small individual pieces around it, right? I think, and then you iterate, you spin pieces, you upgrade the organization. You have your stakeholder, right? I was a front office guy, but you need the back office, you
yeah.
need the AML guys, you need legal, you
Everyone,
need
yeah,
everybody to be comfortable. You only get them comfortable if they actually have to do something, not if they sit in a
yeah,
webinar, right? And I think
yep.
those are so it really resounds. Well, I'm happy I did it right then,
You did it
Prashant,
right.
because it looks like that's a strategy you would advise me to do as well. And then my last question, I think we have a minute, is I usually ask, how do you see it pan out in 10 years or longer? I think you mentioned a number, 10% of the assets in 10 years. That's the EY number. What's your personal guess, right? What's the percentage of investable assets that then are digital, either in the boring traditional DTCCs replatforming? That's what my digital natives say, right? DTCC is replatform, or in that it's crypto, it's full on everything
Yeah.
digital.
Look, I think if in 5 years, if things are, progressing the way that I'm seeing, we won't even be talking about digital assets and crypto. It'll just be talking about financial services. So
Agreed.
some financial services will just operate on chain because it's better. Some financial services will operate through traditional rails because it's better and more convenient. Do I see a world where 100% assets move over in 10 years? No. But do I see a world where in specific use cases, there's a big benefit for usage on blockchain, whether it's cross-border payments or access to new types of products via tokenization? Yes. And so I think in 5, 10 years, we're not going to still be talking about digital assets and cryptocurrency. It'll be financial services, and these are other products and other rails on the back end to support money movement and value exchange.
Sounds great. And we're also at times, so if you just listen to the last sentence of Prashant, you get really worried ping him on LinkedIn. I'm sure he will consult you on what your future strategy should look like. Prashant, thank you very much for joining. Super interesting, went by way too fast. And I think
Too fast.
worth reading the report because it really has some good insights. Thank you, everyone, for tuning in, and hope to see you on the next Joint Custody podcast.